It can be very tempting, especially if you've learnt about evidence-based investing, to manage your investments on your own. But although it's possible, it's not necessarily a good idea. Vanguard, which is best known as a provider of low-cost index funds, says investors who use an advisor usually have better outcomes than those who don't.
We spend a lot of time promoting the value of advice. We have a framework here that we call Advisors Alpha, which talks specifically around the value that an advised relationship will deliver over and above what a client left to their own devices might achieve. We don't say that for clients who have time, willingness, ability to self-serve, that they can't achieve a great outcome too, because that's certainly possible. We just say it's hard, and our message around the value of advice and what that adds is really very clear.
So why do DIY investors often underperform those who use an advisor? Well, one of the main reasons is what's called performance chasing.
Where an advisor really can add value is their role as a behavioural coach, or for want of a better phrase, an emotional circuit breaker. Because I think we see time and time again that when clients are left to their own devices, they can fall into some pitfalls, and they can start to make some very costly mistakes. One of the ways in which we see these mistakes manifest is when clients invest in what appears to be yesterday's winning funds, expecting those funds to repeat the performance and to prevail for the next 3, 5, 7, 9 years. And so there's a clear pattern where the money tracks. Now that's trying to time markets, which is not an advisable thing, but typically again we see investors get there too late, by which I mean there's a big difference between the fund return and the actual return that the investor experiences. So just in those two examples of chasing yesterday's winners and getting there too late, we see some behaviours that really do erode value.
But it's during periods of market volatility that a good advisor will really earn their fees. For unadvised investors, the temptation to bail out when markets start falling sharply can be very hard to resist.
Markets will inevitably experience degrees of volatility, and that's the biggest intervention that an advisor can make. Jack Bogle coined the phrase, the founder of Vanguard, don't just do something, sit there. In other words, expect the volatility, be confident in the plan, ride it out for great investing outcomes.
In short then, yes, you can manage without a financial advisor, but it may end up costing you far more than you thought.